Hello everyone, welcome to the market opening bell for Monday, February 9th, your 10-minute guide to the stock market. Last Friday, the Hang Seng Index opened sharply lower by 531 points. It reached a low of 26,295 points with a maximum drop of 590 points before narrowing its losses, ultimately closing at 26,560 points, down 325 points or 1.2%. The Hang Seng China Enterprises Index hit the low of 8,918 points and closed at 9,031 points, down 62 points or 0.7%. The Hang Seng Tech Index reached a low of 5,275 points and closed at 5,346 points, down 60 points or 1.1%. Total market turnover was 247.8 billion Hong Kong dollars. Southbound funds had total turnover of $88.4 billion with net southbound inflows of $14.859 billion. Among them, Tencent Holdings and Alibaba each saw net buying of 4.324 billion and 1.656 billion respectively. Akasol and YOFC saw net selling of 306 million and 79 million respectively. For the week, the Hang Seng Index fell a cumulative 827 points, or 3%. The China Enterprises Index fell 285 points, or 3.1%. And the Hang Seng Tech Index fell 371 points, or 6.5%, marking the third consecutive week of declines. Southbound funds had net inflows of 56.069 billion for the week compared to net inflows of $2.708 billion the previous week. Technically, the Hang Seng Index once fell close to the 50-day and 100-day moving averages, both around 26,287 points, temporarily holding support. Given the sharp rebound in U.S. stocks last Friday, the Hang Seng Index is expected to follow suit today and rebound, testing resistance at the 20-day moving average at 26,910 points. Last Friday, the three major A-share indexes closed mixed but lower overall. The Shanghai Composite Index fell 10 points or 0.3% to 4,065 points. The Shenzhen Component Index fell 45 points or 0.3% to 13,906 points. The Chinex Index fell 23 points or 0.7% to 3,236 points. Total turnover in Shanghai and Shenzhen markets was 2.1487 trillion yuan. The central parity rate of the renminbi against the US dollar was lowered by 20 pips to 6.959 per US dollar. Tech platform stocks faced selling pressure. Tencent fell 9.7% cumulatively last week, while Alibaba fell 8.4%. The market is concerned about potential changes in tax risks for Chinese tech stocks. Recently, the two major mainland platforms engaged in a red envelope war during the Spring Festival. Tencent's Yuanbao app launched a Spring Festival red envelope campaign with 1 billion yuan in cash red envelopes up for grabs. Alibaba's Tianwen app, Quan, immediately launched the Spring Festival guest plan, investing a total of 3 billion yuan in subsidies in collaboration with Taobao Flash Sale, Flijie, Hammer, Alipay, etc., in the form of free orders and benefit packages. The first round of the Quan Spring Festival guest plan offered free milk tea. According to reports, about 9 hours after launch, AI orders on the Quan app exceeded 10 million. The plan requires users to update to the latest version of the Quan app to receive a 25 yuan free order card, usable at over 300,000 milk tea stores nationwide, including brands like Haiti, Nayuki, Luckin Coffee, A Little Something, and Guming. Kuaishou was fined nearly 120 million yuan by the Cyberspace Administration for involving pornographic and vulgar content, and its stock price fell 2.4%. Kuaishou issued a statement in response saying it sincerely accepts the penalty and will resolutely rectify the issues. Due to deficiencies in the company's technical management and untimely emergency handling, a large amount of pornographic and vulgar content appeared on the platform, causing adverse impact. The company feels deep remorse and apologizes sincerely. After the incident, Kuaishou conducted a comprehensive review of problems in risk awareness, security infrastructure, emergency response, and internal management, and actively took various measures to address the shortcomings. Meituan announced the acquisition of Dingdong Maicai DDL, China's business, for an initial consideration of $717 million. The company believes the acquisition is of significant strategic importance, aiming to expand its frontline warehouse coverage, especially in key regions like East China, complementing its Ele supermarket business, strengthen its supply chain capabilities in fresh agricultural products and private label products, and extend its consumer wallet share from food delivery and dining to home cooking. As of February 4th this month, DDL's latest market cap was $725 million, excluding $270 million in cash to be extracted by the seller. The market value of the assets acquired by Meituan is $455 million. Thus, Meituan's $717 million consideration implies a 58% premium. While this acquisition may enhance Meituan's position in the fresh retail market, the overall fresh and grocery market remains fragmented with intense competition. Meituan still faces challenges in its core local business, and overseas expansion will also consume significant investment resources. Auto stocks fell first, then rebounded. Canadian Prime Minister Carney announced a new electric vehicle strategy, including restarting car purchase subsidies and reforming the tariff system, and stated willingness to cooperate with China to promote local production and export of electric vehicles in Canada, aiming to reduce dependence on the U.S. NIL previewed its first adjusted profit in the last quarter, and its stock price rose 6.9% against the market close at $39.1. Meitu announced that under international financial reporting standards, net profit attributable to equity holders of the parent for the year ended December 31st, 2025 is expected to decline by no more than 30% year-on-year. The decline is mainly due to a one-off net gain of approximately 640 million yuan from the sale of all cryptocurrencies in the same period last year, resulting in a higher base, and 2, a one-off non-cash expense of approximately 512 million yuan this year from issuing convertible bonds to Alibaba. Under IFRS 2, this expense is recognized based on the fair value of the convertible bonds exceeding the principal of $250 million on the closing date. Both items are non-operating and unrelated to the group's main business of imaging and design products. After adjusting for all non-cash and non-operating items under non-IFRS, adjusted net profit attributable to equity holders of the parent for the year ended December 31st, 2025 may achieve 60% to 66% year-on-year growth, mainly driven by rapid revenue growth in the main business, imaging and design products, fueled by a rapid increase in global paid subscribers. Among them, paid subscriber growth in international markets outpaced that in mainland China, confirming the effectiveness of the group's globalization strategy, driven by revenue growth. Gross profit growth exceeded operating expense growth, and the resulting operating leverage effect led to an improvement in profitability exceeding gross profit growth. Beijing Capital International Airport issued a profit warning preliminarily estimating a net loss of 600 million to 700 million yuan for 2025, compared to a loss of 1.39 billion the previous year, representing a reduction in loss of 45.3% to 56.8%, mainly benefiting from the continued recovery in aviation market demand and further strengthened cost controls by the company. The new stock Montage Technology, stock code 6809, which will begin trading today, closed at 151.6 Hong Kong dollars in the grey market on Philip Mart last Friday, 41.8% or $44.71 above the listing price. Excluding fees with 100 shares per lot, paper profit is $4,471. Led by tech stocks, U.S. stocks surged sharply last Friday. The fear index VIX fell 4 points or 18.4% to 17.76. The Dow soared 1,206 points or 2.5%, closing near the day's high at 50,115 points, surpassing 50,000 for the first time in history. The Nasdaq rose 490 points or 2.2% to 23,031 points. The S&P 500 closed 133 points or 2% to 6,932 points. The Nasdaq China Golden Dragon Index, reflecting Chinese concept stocks, rose 279 points or 3.7% to 10,528 points. For the week, it rose 1% cumulatively. Weekly summary for the U.S. market: Dow was up 2.5%, S&P 500 down 0.1% slightly, Nasdaq down 1.8%. Chip stocks performed well, with Nvidia soaring 7.8%, Broadcom up 7.1%, Oracle and Palantir rose over 4%, Micron up 3.1%. Reports indicate that Intel and AMD have notified Chinese customers of CPU supply shortages, warning that delivery times could reach 6 months. It said that Intel's 4th and 5th generation CPUs are particularly short in supply, and due to shortages, Intel server product prices in China have generally risen by more than 10%. Sources say AMD has also notified customers of supply shortages, with delivery times for some AMD products extended to 8 to 10 weeks. The market is concerned about overinvestment in data centers. Nvidia CEO Jensen Huang said last Friday that hyperscale data center operators' total capital expenditure this year could reach $660 billion, much of which will be used to purchase Nvidia chips, and he believes the spending level is moderate and sustainable. He's not worried about overcapacity in the tech industry. Unlike the early internet expansion, there is currently no idle infrastructure. Companies like Anthropic and OpenAI have already generated profitable revenue. Tesla rose 3.5%. Founder Elon Musk said on Thursday last week that SpaceX and Tesla will produce solar energy and aim for an annual solar cell production target of 100 gigawatts. According to informed sources, Tesla is evaluating multiple U.S. sites to start solar cell manufacturing. One component of the plan is to expand capacity at its Buffalo, New York factory, potentially to 10 gigawatts, equivalent to the power generation of 10 nuclear plants. In the long term, one option may involve building a second facility in New York State. Microsoft rose 1.9%, Apple rose nearly 1%. Amazon reported a 6% increase in last quarter profit, slightly below expectations, and forecasted $200 billion in capital expenditure this year. Its stock fell 5.6%. Alphabet also fell 2.5% against trend. Sportswear retailer Under Armour reported a 5% decline in third fiscal quarter revenue to $1.33 billion, above the previously expected $1.31 billion. Adjusted earnings per share of 9 cents, far better than the expected loss of 2 cents. The company expects adjusted earnings per share of 10 to 11 cents for fiscal 2026 compared to the previous expectation of 3 to 5 cents. Gross margin is expected to decline by 1.9 percentage points, mainly due to tariff costs. The company added that it has reduced discounts and plans to cut about 25% of its product lines, focusing on higher-priced products in training, running, and team sports categories. The University of Michigan U.S. Consumer Sentiment Index rose 0.9 points to 57.3 in February, the third consecutive monthly increase, above the market expectation of 55. Despite the improvement, confidence remains about 20% below January 2025 levels. On prices, one-year inflation expectations dropped sharply from 4% in January to 3.5%, the lowest since January 2025. Longer-term inflation expectations rose for the second consecutive month from 3.3% to 3.4%. Our stock pick today is Angelalign Technology, stock code 699. Angelalign Technology primarily engages in providing digital clear aligner orthodontic solutions. In mainland China, the group has proactively laid out strategies for early orthodontic intervention and penetration into lower-tier markets, cultivating these as key drivers of business growth. In the first half of 2025, the mainland China market achieved approximately 108,600 clear aligner cases, representing a year-on-year growth of 14%. In the field of early orthodontics, the group has worked to raise public awareness of the benefits of early intervention for children's oral health, while also strengthening the brand influence of Angelalign. This has led to a continuous increase in the proportion of cases achieved with the group's children's version products, demonstrating strong market recognition in the early orthodontics segment. In lower-tier markets, the group has continued to enhance the professional service capabilities of its sales and clinical medical teams. In July of last year, it completed a strategic investment in the clear aligner brand Shu Yaqi. Through its high-cost performance products and extensive clinic channel network, this has accelerated market penetration, resulting in a steady rise in the proportion of cases from lower-tier markets. In global markets outside mainland China, the group has expanded its market coverage by leveraging high-quality medical design support, stable delivery, ongoing educational training led by key KOLs, and customized aligners for simple cases tailored to key strategic clients. In the first half of last year, the group achieved approximately 117,200 clear aligner cases in global markets outside mainland China, including cases from the Angelalign brand, Editech brand aligners, and customized aligners for simple cases of key strategic clients, representing a year-on-year growth of 103.5%. This reflects the group's initial success in entering new markets where it previously had no presence. In the first half of 2025, the group intensified technological innovation, launching multiple innovative products and solutions centered on needs such as early orthodontics, complex cases, and digital diagnostics and treatment. These include the industry's first caries preventive clear aligner, which effectively addresses dental health issues during orthodontic treatment through innovations in materials and structure. The group also released several digital products, including iOrtho 225 and the intraoral scanner Angel Scanner A8. In terms of digital upgrades, the group introduced the Muli oral monitoring device in mainland China for tracking orthodontic progress. In markets outside mainland China, the Angelalign iOrtho platform has achieved software integration with a globally leading remote monitoring solution provider, enabling orthodontists to remotely order adjustment aligners for patients without requiring additional in-person follow-up visits. To support the rapid global business expansion, the group has initiated the construction of a more resilient and diversified global supply chain. As part of this initiative, the group plans to build or expand manufacturing and solution design facilities in key global locations. For example, the medical design centers in Brazil and Southeast Asia are now providing medical design services for the United States. This increasingly comprehensive network layout will ensure timely and stable product and service supply for global clients. Recommended buy price $72, target price $79, stop loss $68. I do not hold the above stock.